Hi, this is Dr. Jeff Camarda with a pretty interesting question. Is the bear market finally upon us as we approach the middle of 2018? In a word, no. I really don't think so. While I appreciate that the recent volatility has concerned many investors, I think it's really just representing a return to a more normal market behavior pattern. As humans, we're pretty well hardwired to project the recent past into the future and expect more of the same, even though we frequently don't get it but get something different. Looking at what the S&P 500 has done so far since 2016, it's gone pretty smoothly up until it hit the wall as we saw in early 2018. Now, before I get into my forecast of what to expect going forward, in my view, it's important to reflect a bit on this normal volatility. What we've seen so far in 2018 is fairly typical and pretty similar to the period in mid-2015 to early 2016. Investors must remember that volatility, swings in value, sometimes violence, is the price of stock market success. Given a long enough time frame, a well-diversified stock portfolio is virtually assured to be quite profitable based on history. The price of such success is the scary bumps and bone-jarring drops that send many folks over the emotional cliff, who make decisions very much in not in their best interest, selling at lows and so forth. As one pundit wisely says, the biggest risk in the stock market is to not be scared out of it. Now, I remind you of this because I think this volatility is far from over for 2018. As many of you know, I felt that U.S. stock valuations have been lofty for a while, and I've been expecting a substantial correction for some time. I think it's finally arrived, and it's not yet over. It's worthwhile to ponder the term correction a bit. Investopedia defines corrections as a generally temporary price decline interrupting an uptrend in a market or an asset. A correction, according to Investopedia, has a shorter duration than a bear market or a recession, but can be a precursor to either. But the correction, and this is lost when most people use the term, the correction in the term is a correction of pricing, a market recognition that prices have got a bit out of whack to underlying value and need to be adjusted to reflect economic reality. So far in 2018, the U.S. market has already endured an official correction, which is a drop of at least 10% from peak values. Now, the official definition of a bear market, by the way, is a 20% or greater drop from the peak. But the term bear market strongly implies a protracted down market driven by recession or other very negative economic factors. So while I think that the 2018 correction may yet be more severe, I don't know about 20%, but I think worse than 10. I do not think any upcoming sharp drop signal a bear market. And I firmly believe the U.S. bull market, we remain in bull market, and I think the bull market will continue for some time, probably a couple of years, and that the non-U.S. stock bull market has a very, very long time to go. As you recall, I think that non-U.S. stocks, many of them are much better values than U.S. stocks for reasons we've gotten into in other places. Still, current conditions underscore the need for investor caution going forward. In the long run-up from the bottom in 2009, it seems that nearly everything has gone up. Individual stock pricing has not mattered, and so-called passive index investing has been the best way to go. Because now, again, of how the brain works, way to go becomes is the way to go, but going that way can be very dangerous now. Let me reiterate, just because things work well and our brain recognizes the pattern, believes that work well before, we'll get more of the same, that it's dangerous to assume that the future will replicate the past. It often doesn't. And people that follow an outdated methodology, often to their peril, often take a long time before they learn the hard way that maybe that wasn't the best way to do it. The recent sharp reversals of arguably greatly overvalued tech stocks has really been a stark reminder that this may not be so. and that the informed care in picking quality companies trading at attractive prices may in the end be a better way to go than simply buying the entire market, regardless of the quality that it may contain. Now, let me say that again. Buying the entire market like an index, like the S&P 500, regardless of what's in it, whether it's really high quality, maybe not so high quality, or a mixture as it often is. For more on this, please see my video upcoming called Tide Going Out on Those Naked Index Investor Swimmers later on in the month. So while Camarda believes that the U.S. bull market still to have very strong legs and will go for a while, successful investors will need, we think, to be more choosy going forward and to look to buy good quality relatively cheap in order to succeed in what we see as a generally overvalued U.S. market condition. The recent trade war posturing between Mr. Trump and the rest of the world, China, of course, has injected a more than healthy dose of fear into a giddy market overinflated by heedless greed. Now, while Camarda believes Trump is playing a pretty shrewd game of economic chess that will ultimately improve fairness and prosperity to America's global trade, the uncertainty is creating some really nice buying opportunities in carefully selected U.S. stocks. Those of you that have followed me for a while know that I've been expecting a hot gush of air to come squirting out of the overvalued stock market balloon for some time, and I think that we are here, or at least at the beginning stages of this gush. This is not a time for fear. Please don't be afraid, but it is a time for understanding so that you make decisions that are lined up with your financial interests. As many of you know, Camarda believes that Buffett-style value investing, buying high quality cheap, is the smartest way to invest. Those of you in Camarda portfolios are invested with this in mind, and we believe that you're well positioned for the markets ahead. Those who are not may want to deeply consider this, and if they've recently gotten a taste of what Warren Buffett is talking about when he said, you can only find out who is swimming naked when the tide goes out. What he meant by this, of course, is that in a raging bull market where caution's flown to the wind, that it really hides a lot of risks and sins, like buying iffy stocks for crazy prices. It's very easy to look like a genius in a bull market, but when the music stops, when the tide goes out, it becomes a lot more evident that it really matters what you buy and what you pay. Camarda thinks this may become the bane of many a passive investor and index investor who will not understand why the markets may become unforgiving and why indexes may founder while some stocks may thrive. Finally, given a forecast for bumpy skies ahead, it's important to remember that over the long term, which probably means for the rest of your life, stocks are probably the best asset you can own that does not require active work like running real estate or a business. This is so important, you should burn it into your brain so that you're strong when the inevitable bone-jarring market drops happen. You have to remember to not be scared out of the markets. The following facts should offer some comfort and cause for courage. If you'd invested $1 right before the 1929 crash and put it in cash, after inflation, but before taxes, it would have grown to about $8 as of the end of 2016. In bonds, that dollar would have grown to be $121, but in stocks, you would have had about $6,000. Big difference. When you add value stocks trying to buy quality cheap, as Camarda does, that number really goes off the chart. But the really important point that I want to leave you with and maybe fortify you with against the chop ahead is that if you can make yourself be patient, for most investor stocks really are the only smart game in town. From a long-term perspective, stocks are remarkably predictable and stable and superior. Just don't outsmart yourself and get scared out of them. Also remember that in the long run, value investing, the sort that Camarda espouses, where you look to buy good stocks on sale, high quality companies cheap, that sort of investing tends to really outperform, beating growth stocks, for instance, by close to 50% per year on average, and long-term bonds by something like 160% per year on average. For reasons explored in previous newsletters and videos, Camarda firmly believes value will outperform by even greater margins in the years and decades ahead. Thank you so much for suffering through that rather long-winded exposition. Until next time, thanks for watching. I am Dr. Jeff Camarda.